thinking about as we look at this new coronavirus package. There are a bunch of things. We're not going to have time to go through all of it, but we'll start with what is obviously the biggest one everybody is worried about or been thinking about. I talked last week about how the problem with the PPP loan was that the terms came out and everybody thought it was going to be treated as essentially a tax-free grant. The IRS back in May released Revenue Notice 2020-32, which alarmed a lot of PPP borrowers when the IRS took the position that expenses that were paid with forgiven loans would not be tax deductible. This is a big problem and was basically against what Congress intended. And, Senators Grassley, Neal, Ron Wyden had written a letter to Secretary Mnuchin basically reaffirming Congress's position that this shouldn't have been done that way. The problem with that is that's not the law they passed. They passed a law that wasn't clear about this. And so this revised act passed by Congress on the 21st, signed on the 27th or 28th, solidifies this position, in part stating, no deduction shall be denied or reduced, no tax attribute shall be reduced, and no basis increase shall be denied by reason of the exclusion from gross income provided by paragraph 1. Now, the point is that these deductions may have been restricted in some way, but there really doesn't appear to be anything in the act that says this is really going to be the case. Additionally, owners of S corporations. So S corporations are not a type of entity, they are a tax status. So owners of S corporations and partners in partnership will receive a step up in basis attributable to the tax exempt income that results from PPP loan forgiveness. So most borrowers, this basis probably won't incur until tax year 2021 when forgiveness is actually confirmed. But there is something, it's just if you've got a partnership or if you've got an S Corp, just knowing that you're going to get that basis step up once that comes through. And, you're going to be looking for a sale sometime in 2021. So owners wishing to have those losses that they might be able to take, well, you may be stuck waiting until next year unless somehow you've been able to force through or get confirmed your forgiveness already. Basically, the loans are going to remain suspended until the basis is increased in 2021. So, going on, what else do we have? So I'm just kind of going down the notes I took. So section 272 to 273 of the bill, it'll end up being somewhere else in the IRC or Internal Revenue Code. You're going to get additional 2020 recovery rebates for individuals. So there will be another refundable tax credit in the amount of $600 per eligible family member. So that means if you had basically $600 treated as a credit, the credit is $600 per taxpayer, so $1,200 for married filing jointly, in addition to $600 per qualifying child. Now, this is not for everybody. Once you start hitting $75,000 of modified adjusted gross income, or $112,500 for heads of household, or $150 for married filing jointly, the income is going to start, or the amount of the credit is going to start phasing out at a rate of $5 per additional $100 of income. So if you had $75,000, there's no phase out. $75,000 and $100 of income, then you get a credit of $595. So kind of, I'm not going to do the math in my head, but basically it starts phasing out, and eventually if you make too much, you're just not going to get anything. So in general, taxpayers are going to be able to claim this, but you must have an eligible Social Security number. If you don't, then you're not going to be eligible for that payment. So the one wrinkle would be married taxpayers filing jointly, where only a single spouse has a Social Security number and one that doesn't are eligible for the $600 payment, in addition to the $600 per child payment, as long as everybody has a Social Security number. What else? There's going to be an extension of the deferred payroll taxes. You may remember way back in August of this year, President Trump issued a memo allowing employers to defer withholding employees' shares of Social Security taxes, that's the 6.2%, and their railroad retirement equivalent from September 1 through December 31, and required employers to increase the withholding and pay any deferred amounts ratably from wages and compensation paid between January 1, 2021 and April 31, 2021. So basically, employers could allow employees to take that tax that they would have had withheld, keep it for now, but then you'd have to take it out of wages come January of next year. And then beginning May 1 of next year, penalties and interest on those deferred unpaid tax liabilities would begin to accrue. When asked about this, I said, well, why even bother? It seems like a lot of headache. Just go ahead and don't change what you're doing. Payroll taxes are a big headache. If you want to get in there and futz around with, we're going to withhold now and then we're going to disappoint our employees later when we start reducing their wages for double withholding. 6% is a big chunk out of a paycheck. It just didn't make sense to me. Here, they're extending it, so this provision now extends repayment through the end of next year. Penalties and interest on that don't start accruing until January 1 of next year. I mean, essentially, if you did this, and I didn't think it was a good idea, your circumstances may have been different, you now have all year to ratably pick that up. Frankly, it just struck me as a silly idea that there may be some good use cases for it, but I just couldn't see upsetting your payroll and withholding systems. It's just keep it in place. You don't have to worry about juggling any sort of payment or any of the rest of it. Just keep it in place. Let's see, Section 275, regulations on or guidance clarifying the application of Educator expense tax deductions. So what Congress is doing in this is allowing the Secretary to issue guidance or regulations, basically let the IRS come up with the rules, providing that personal protective equipment and other supplies used for the prevention of the spread of COVID-19 are treated as eligible expenses for purposes of the Educator expense deduction. These are going to be retroactive to March 12, 2020. This, if you can take that Educator expense deduction, and I'm not sure everybody can, it may be something that just goes to teachers. I don't think everybody can take that, but it might be worth going in and checking on that. Let's see, we already talked about 276 already, because this was the top line, that the clarification on the tax treatment of the Paycheck Protection Program loans. So gross income is not going to include any amount that would arise from the forgiveness of the PPP loan. Normally, forgiveness of loans is treated as gross income. So you would have gotten this, essentially free income. But that free income would have come at the cost of you're going to pay income tax on it. So free money, but not without the income tax bite. Congress is coming back and saying, no, at this point, you can take that as free money. Section 277, emergency financial aid grants. This allows certain emergency financial aid grants under the CARES Act are excluded from gross income of college and university students. Again, this is basically saying, look, if you got grants, we're clarifying that this is not going to be taxable income. It's also going to hold students harmless for the purposes of determining eligibility for American Opportunity and Lifetime Learning tax credits. So basically, it's effective as of the CARES Act. We want to kind of roll that back. You're not going to be dinged for having gotten that grant. So why those Opportunity and Lifetime Learning credits end up being tied to your income, they don't want this interfering with that. Section 278, clarification of tax treatment of certain loan forgiveness and other business financial assistance under the coronavirus relief legislation. So they were getting into gross income is not going to include forgiveness of certain loans, certain EIDL grants, and other repayment assistance. All is provided by the CARES Act. So this is going to clarify that any deductions that are allowed for otherwise deductible expenses and paid with amounts not included in income by because it is a coronavirus PPP loan, that tax basis and all the rest, you still get that. You're not getting double dinged on it. So provision is going to be effective for tax years starting in 2021. Let's see, Section 279, you can IRS is getting the ability to waive certain information reporting requirements. So Treasury can waive information filing requirements for any amount excluded from income because the exclusion of covered loan amount forgiveness from taxable income. So basically, there's not a direct requirement here. When I see this, it's like they can basically waive your having to provide certain information, but they haven't said exactly what that's going to be. It's more of a, here, if you think this is right, go ahead and take it out. We're not going to really make sure that we're not going to direct, you don't have to provide this. It's almost, this is how Congress gets the IRS in trouble. They say, here, kind of do what you want, and then Congress says, well, you didn't tell us exactly what we can do, and so we don't really know what to do. It seems like a good idea, and ultimately it may make things a little worse just because there's no direction. It's, like, oh, we don't know, just go do something. So there's that. I'm going to kind of go back to the top of the bill, see if there's anything else that makes sense. Let's see. Tax treatment of the EIDL advance fund. So there was this other quicker loan, and what happened? Well, it doesn't need to be repaid up to $1,000 per $10,000 total. Earlier law stated that received, or any amount received, would reduce the loan forgiveness, essentially requiring the advance to be repaid. The new act that was just signed repeals this provision, so if you had received that EIDL advance, you won't have an impact on your PPP loan forgiveness. So borrowers that have already applied for and received loan forgiveness presumably may have to amend their application request to get that EIDL advance covered. So something new. I'm not going to get into eligibility for PPP round 2. If this is something you're interested in, just let me know in the comments, and we can come back and do a separate stream on that. We do have also some forgivable expenses. So operations expenditures, payments for business software, cloud computing service that facilitates business operations, essentially anything to work remotely, that's going to be a forgivable expense under the PPP. Property damage costs, so costs related to property damage and vandalism or looting due to public disturbances, and was not otherwise covered by insurance, that's going to be a forgivable expense. So if you had that, then that would be something they're just clarifying. You're not going to get dinged for that. Covered supplier costs, so expenditures made by an entity to a supplier of goods for anything that essential to the operations of the entity at the time at which the expenditure was made, which is really kind of vague. Like if you needed it at the time and you paid for it, then we're gonna let you have it. It seems really vague, and it seems like this may end up causing more problems because the IRS is going to be in the position of saying, well, did you really need that? Who knows? Covered worker protection. So basically adapting and what you needed to get to facilitate the adaptation of business activities of an entity to comply with the requirements established by Health and Human Services or CDC or OSHA. So whatever it took to get your business in line so you could operate, that's going to be covered. Scrolling through the list of this, I think that's about it for things that we want to be thinking about for, in terms of specifically tax things. Again, if you have questions more on PPP loans and what that means, go ahead and drop a comment and we will take a look at it. So John Strohmeyer, thanks so much. Have a great one.